Welcome to the Fund Funds Expert Talk. I'm Mike Mbayi, Head of Banking and Finance of the Luxembourg law firm Praxio. And today I have the pleasure to welcome Priyanka Chandran. Hi, Priyanka.
Hey, hi, Michael. How are you?
I'm doing great, thank you. What about you?
Amazing.
So maybe first you can further introduce yourself, your bank, and your role at the bank.
Sure. So, my name is Priyanka Chandran. I am a director in the Corporate Banking Financial Institutions Group at Bank of Montreal, based in New York. Have been with the firm for over 7 years now, where I'm responsible for scaling and managing BMO's fund finance portfolio, which includes subscription lines, NAV facilities, and management company facilities.
Thank you, Priyanka. And can you tell us more about your career, how it started, and
Sure. So I would say I spent the first decade of my career, across corporate banking and global markets, driving revenue growth in Asia, and this was during my time at Deutsche Bank. I pivoted then to an internal role within our COO's office. When I moved to Europe, I was based in London at the time before transitioning to North America as a FIG banker. So I started in Toronto office at BMO and then subsequently moved to New York.
Mhm. And Priyanka, were there like key decisions in your career?
Yeah, I would say that, having worked across multiple geographies and different businesses, my initial career decisions were very driven by the desire for continuous growth and, trying to be a more well-rounded banker. I think over time, I've been very intentional with my desire for operating in larger markets and having the opportunities to build and grow high-performing teams.
And for your career, do you have like a personal mantra or an
Yeah,
inspiration?
I think this is something dynamic, right? It's kind of changed over time. Michael, when I was younger, as a young banker, it was very heavily focused on achievement. And then it was all about time. And I think more now, I feel it's very heavy on experience. Um, I would say the general philosophy of life, which also applies to businesses, you always want to do good by people, or you want to make sure that you don't do or behave with people in ways you don't want other people to behave with you, right? And so I would say that has been a guiding belief in both my personal and professional life, whether, this is work, leading teams, and sort of what I live by.
Yeah, that makes sense indeed. And in terms of market, what are you currently seeing in the market?
I think it's extremely interesting, right, Michael? And, the market has been extremely dynamic. And the fund finance market, the beauty of this market is that it's been constantly evolving, right? Some of the key things that we see in the market today include, a big focus on more and more demand for structured products and solutions, whether this be through specific kind of asset-backed facilities or NAV facilities, whether these are GP facilities or hybrid facilities, um, which we didn't see that much of, I would say, even 5 years back, right? There has been a lot of activity in terms of the non-bank lender space, and they've been very active in this market, whether this is through insurance capital or through, you know, other private capital, other forms of private capital, right, which has been very complementary, I think, to the bank capital market and the supply from the bank market, and has also actually helped cater to this supply for structured solutions, which is coming into the market now. The other interesting aspect has been the intersection of securitization technology with fund finance. Um, whether this comes in the form of CFOs or rated note feeders that we see in the fund structures and catering to specific types of investors on the demand side, but also, we see that from a velocity and balance sheet management perspective on the supply side with banks trying to do SRT trades in order to optimize their balance sheet. That has again been, an extremely interesting development. And overall, I would say fund finance is sort of becoming its own asset class, right? With GPs trying to get more exposure to this asset class, whether this is through SRTs, whether this is, through setting up forward flow agreements with banks. So I think overall the market is moving, and that's been the beauty of this market.
Yes, let's focus now more on the financing of fund of one.
Yeah.
So, what is the difference of a fund of one regarding vis-à-vis, I would say, regular fund or other type of funds?
Yeah, so as the name suggests, right, fund of one, or, we call this separately managed account, is typically a fund with one investor, right? It has generally, these are usually set up as a co-investment vehicle for a single investor that is investing alongside a fund or multiple funds with a particular manager. Um, and the reason for doing that is that it provides a lot of customization for the single investor. And these customizations and desire to set up this fund structure could be driven by tax considerations, special consent rights, or special economics that the investors negotiated with the GP. Typically, what we see here in North America are fund of ones with North American pension plans, so whether these are US state pension plans or Canadian pension plans. We also see a lot of this with Asian sovereigns and some North American insurance companies.
Mhm. And what are the key diligence points that you do on the investors and the key points regarding the underwriting process for the type of transactions?
I think for the most part, the structure is very similar to a commingled fund, right? I would say high level. So what I mean by that is, as lenders, we would need to diligence the LPA, we would need to diligence the subscription agreement of the single investor. We would need to also diligence any side letters, right, in the transactions. But I think where the nuance or the difference is that most banks for a fund of one would request an investor acknowledgement letter, which is a direct acknowledgement from the investor to fund capital calls without and not solely rely on the provisions which are in the LPA. And then, depending on whether the investing entity is an SPV or directly the investor, there may also be a comfort letter required from the parent or the sponsor effectively, which may be the pension plan or the sovereign, which is the LP in the case. So trying to understand the investor is sort of important, and where is the money flow coming from.
Mhm. And in terms of structure, what structural protection can mitigate the risk vis-à-vis this solo investor?
Right. I think in terms of diligence, ultimately banks need to be comfortable with that investor, right? Because that is the only investor who's responsible for funding the capital commitments, and that is the ultimate recourse that the bank has on in terms of the facility construct. But I would say that how some of the structural provisions in the credit agreement itself are different is, typically in a commingled fund, when a single investor defaults on a capital commitment, they would typically be excluded from the borrowing base, right? So that will lead to an exclusion event. But given a fund of one has only one investor, it would actually lead to an event of default, right? Banks also want to see some sort of a rating triggers, which is tied to the LP's rating. So usually this is two notch in the market. And then every LPA is different, right, Michael? So, but having some sort of a clean down construct, whether this comes through the LPA or through the credit agreement, the lenders do want to make sure that capital does get called at some point in time, right? And not everything gets put on the facility so that the investor has skin in the game.
Mhm. And also from a legal perspective for the security package, for the pledge or joint commitments, generally we also request an investor letter since you have only one investor. This is,
Correct.
yeah,
Correct.
it's,
So we would request an investor acknowledgement letter. And if the investing entity is actually an SPV or like a subsidiary of the pension or the sovereign, then there would also be a comfort letter, which would be requested directly from the sovereign, basically showing their support towards the investing entity, which in most cases is an SPV.
mhm. And in the credit agreement, what are the provisions which are heavily negotiated by the lenders?
I think in general, the notice periods and the cure periods, right, do get quite heavily negotiated, Michael, given ultimately there isn't an exclusion event with a fund of one. It effectively, if the investor is defaulting on the capital commitment, it leads to an event of default. The other provisions which we see kind of are negotiated quite a lot include the provisions around transfer or withdrawal rights, right? They're typically restricted in a fund of one. There may be some cases where a transfer to an affiliate is permissible, right, with the lender notification. But this is important because ultimately the recourse is to the investor, right? And like I said, banks and lenders want to be comfortable with the investor. So transfer provisions, I would say, are extremely important, right? And I would say overall, like, understanding and comfort with the sovereign immunity provisions are important. Not these aren't necessarily sort of points which get negotiated, but having requisite verbiage and making sure banks are comfortable with that provisions that are outlined, whether this is be in the subscription agreement or in the side letter, those are important, right? Yeah, and typically the verbiage of the acknowledgement letter, that is extremely important, right? Banks need to be comfortable with that, and that is kind of where we see that does take time, and lenders want to kickstart on that process early to make sure that that has been negotiated between the investor, the GP, and the lender, to make sure all parties are happy with that form.
Mm-hmm. And now coming back to the market, so 5 years from now, how do you see the funds market?
I wish I had a crystal ball, Michael, but I would say, there are different numbers around estimates for kind of where the fund finance market is. I would say somewhere between 1.2, 1.3 trillion is kind of where the market is. And so I would say definitely expect this market to grow and become much bigger. And if I had to point and put a number in the air, I would say maybe 2 trillion, over 2 trillion. I feel that, the demand for structured solutions is increasing, and expect this to continue and grow. And the market for NAV and hybrid facilities to become more evolved, more bigger, more deeper. I would say that is something which we see is happening and continue to foresee happening in the future. And finally, I would say that, from we haven't talked about AI so far, in this conversation. And so, I would say use of technology, right, Michael, to increase efficiencies, whether this is from an operational standpoint for LP or capital call tracking from a GP perspective, and other aspects of portfolio management from a lender perspective, continue to see that grow and develop, I would say, over the next couple of years as the market continues to grow and evolve.
Mm-hmm. Thank you very much, Priyanka, for your time today and for this insightful conversation. And thank you as well to the audience for your time, and see you soon for next Fund Expert Talk. Bye-bye.
Thank you so much, Michael. Bye-bye.
Our pleasure. Bye.